The gold-silver ratio is a fascinating financial metric. It tells us the value of 1 ounce of gold compared to 1 ounce of silver. Essentially, it reveals how much silver you would need to trade to acquire an equivalent amount of gold. This ratio is not static. It fluctuates based on the market dynamics of both precious metals. For investors, this dynamic relationship can unlock unique investment opportunities. Imagine walking into a precious metals dealer and seeing the price of gold and silver displayed side by side. The gold-silver ratio helps you understand the relative value between the two metals at that moment. It's like a seesaw. When the ratio is high, gold is comparatively more expensive than silver. Conversely, a low ratio suggests that silver is more expensive relative to gold. This constant dance between gold and silver has captivated investors for centuries. By tracking the gold-silver ratio, we gain insights into market sentiment and potential price movements, which can inform our investment strategies. Understanding this simple ratio can be a valuable tool in your investment arsenal. Calculating the gold-silver ratio is straightforward. Divide the current price of gold by the current price of silver. For instance, if gold trades at $1,800 per ounce and silver at $22.50 per ounce, the ratio would be 80. This indicates that 1 ounce of gold could buy 80 ounces of silver at that time. A high ratio suggests that silver is undervalued relative to gold. Conversely, a low ratio implies that silver is overvalued compared to gold. Investors often view a high ratio as a potential buying opportunity for silver or a selling opportunity for gold. However, it's crucial to remember that the ratio is just one factor to consider when making investment decisions. Thorough research, market analysis, and personalized risk tolerance should always guide your investment strategy. Looking back, the gold-silver ratio has fluctuated significantly. Historically, the ratio has averaged around 40 to 1, meaning that, on average, 1 ounce of gold could buy 40 ounces of silver. However, this ratio has deviated widely from the average throughout history. In ancient times, the ratio was often fixed, reflecting the perceived value of the two metals. For instance, the Roman Empire set the ratio at 12 to 1. During the 20th century, the ratio experienced substantial volatility, influenced by wars, economic crises, and government interventions. In the modern era, the ratio reached an all-time high of over 100 in the 1990s, indicating extreme undervaluation of silver relative to gold. Today, the ratio continues to fluctuate, driven by factors such as supply and demand, investor sentiment, and macroeconomic conditions. Understanding these historical trends can provide valuable context for contemporary investment decisions. Savvy investors utilize the gold-silver ratio for various investment strategies. One common approach is ratio trading, which involves buying and selling gold and silver based on the ratio's movements. For example, when the ratio is historically high, investors might sell a portion of their gold holdings and buy silver, aiming to capitalize on silver's potential to outperform gold as the ratio reverts to its mean. Another application is portfolio balancing, where investors adjust their gold and silver holdings to maintain a desired ratio based on their investment goals and risk tolerance. For instance, an investor aiming for a balanced portfolio might adjust their holdings to maintain a ratio closer to the historical average. Let's consider a practical example. Suppose the current gold-silver ratio is 80, significantly above the historical average. An investor might decide to sell a portion of their gold holdings, say 1 ounce, and use the proceeds to purchase silver. If the ratio reverts to the historical average of 40, the investor would have effectively increased their silver holdings by a significant margin, potentially amplifying their returns. However, it's essential to remember that no investment strategy guarantees profits. Thorough research, careful planning, and prudent risk management are paramount for success in the dynamic world of precious metals investing.